Well, a sharply lower day in grain and livestock futures trade on Friday. Sean Hackett with Hackett Financial Advisors is joining us for markets now. Okay, Sean, we know there was a lot of uncertainty in the market on Friday, creating risk off. Some of it was tariffs, but there was more to it from an economic standpoint, wasn't there?
Yeah, I mean, very weak retail sales. The Atlanta Fed produced their GDP now number for the first quarter of 25, showing a minus 1.5 GDP number, a contraction in the economy. Just a lot of concern that we're finally breaking the back of the U.S. economy and the world economy, and the tariff war that seems to be developing is stoking those fears. And when you're worried about those sort of things, you take risk off, you sell first, ask questions later. And that's what we saw with the big tech stocks, with commodities across the board. And we saw safe haven buying in 10-year treasuries and 30-year treasuries, which means lower interest rates based upon a flight to quality. So it was a classic trade based upon those fears.
And of course, you're going into a weekend, and so you want to maybe protect yourselves a little bit or get on the sidelines, because who knows? Is it possible we could get something worked out on these tariffs over the weekend?
There's absolutely a chance that we could come in on Sunday night or Monday morning with a dramatically different view of how this trade tariff thing is going. Absolutely possible. But when you're over risked in one direction, if you're over risked on the long side, you're willing to take that risk off just in case that doesn't happen. You can always buy back later if it looks like that you over de-risked yourself.
Looking at tariffs, run me a worst case scenario. If we get 25% tariffs on Canada and Mexico, another 10% on China, what are the commodities that are hit the worst?
Well, it's the fear over what's the retaliation, right? What are they going to retaliate with? Is Mexico going to retaliate by putting tariffs on corn imported to them from us? We don't know that yet, right? The fear is that the retaliatory is going to go against our ag products because that's an area that we're very sensitive to. But I would argue that given that Mexico is dealing with a mega drought of multi-year duration and they need corn so badly, they may not choose corn as the market to put tariffs on. They may choose other products that are not as important to them. So that's what we have to work out. But the fear is going to be, for right now, and the trade's putting it on, that they're going to retaliate against things that are most important to us, which is corn, cotton, soybeans, dairy, for example. But I'm not so sure that's how it's going to ultimately turn out. It'll take time to work through that.
So on top of that, the corn market got some bearish news on acreage this week, and that market, from a technical standpoint, took out some pretty key support here. So are you worried the funds are going to really hit the sell side of the market?
I mean, they started hitting the sell side of the market, and I think they are in full sell signal mode. Once they decide that they don't want to be in a position anymore, they continue to sell until their risk is down to a level that's more manageable. We broke a big uptrend line, broke through support. It still says that even though we've given a decent amount back here from the highs, on July contract, that 450 level is a technical target we think we may need to go to, which is another 20 or 25 cents down from here before some of that excess selling resolves itself, and we might find some stabilization for a little while.
And despite lower acres, it looks like the soybean market kind of rolled over here as well. We took out some pretty key moving averages in that market. So the tariff news, the other selling in the other parts of the complex kind of overwhelmed the beans.
Absolutely. Tariff wars don't help the sentiment in soybeans. A big crop in Brazil that's now gaining steam in terms of the harvest pressure coming in the next 2 to 3 months. It's lower acres, while constructive, is not enough, in my opinion, this time of the year to override those factors. And certainly with wheat and corn under pressure, it's going to give into that.
So South American harvest pressure, part of the downslide in soybeans on Friday. But do you anticipate that we're going to continue to see harvest pressure going forward here now?
Absolutely. I mean, harvest pressure shouldn't really be peaking here historically until you get into the latter part of March, early April. And then those that have to sell down there, that need to move soybeans that hit the market, are kind of done with that. And then those that are left are in stronger hands, and then they pull back a little bit. So I clearly see this being a trend for at least another 30, maybe even 45 days.
And the wheat market, we took back a lot of what we put on here the last couple of weeks, putting in weather premium. So how much lower will we go there?
Well, we put 80 cents on roughly, and then we took 60 cents back. If you look at where we are now on, July SRW, or even on KC, HRW wheat, we're kind of back to this 2-year support area that the market has had an unwillingness to go much lower. And I kind of feel, at least in the wheat complex, probably most of the damage has been done. We weren't that long with the funds. We got them, or probably got them super short again. And I'm really concerned about a very cold spring season here that could create a frost scare or a legitimate frost event that the winter wheat market will have to contend with, like it did last year when we put over $2 on the market when Russia-Ukraine had that. So we're very concerned about some unfavorable cold weather here to re-excite the winter wheat market.
That should also help put some excitement back in the corn market, though, at planting time, right?
Absolutely. We can say 94, 95, or 96 million acres, but it doesn't mean we're going to plant it. Yes, core acres are going to go in the ground no matter how cold it is, but those fringe acres, which you need to make up a large corn acreage number like we're talking about, won't get planted if our forecast is correct. That definitely would be constructive to the corn market, which already has pretty constructive old crop fundamentals right now.
With some of the selling pressure liquidation we saw this week also tied to end of month, and the fact that first notice day coincided with today?
Yeah, it's always amazing how you get a confluence of month end, first notice, all these economic numbers, the tariff news. It just seems we had a culmination that created what could, kind of a maximum reason to get some risk off the table. No question, it was not just one thing, but a cumulative things that made it such an awful week for risk off.
So the cattle market also got hit hard on Friday, although I do not see tariffs maybe being as negative for cattle as other sectors. So was that lower cash or these economic fears you talked about?
Yeah, I mean, on the margin, a tariff war technically could be bullish for the cattle market. I mean, that's how I would look at it if we're not going to import as much cattle in from Mexico or Canada. But I think that the economic concern has got so worrisome this week, Michelle, that I think that's the overriding factor that's overriding what is somewhat of a constructive tariff war, at least for the cattle market. You print a negative GDP number from GDP Now from the Atlanta Fed. I mean, that's just not something the cattle market has historically wanted to see, and you're going to get risk off in that market. And even, like I said, beef cutout prices, pork cutout prices, they haven't been behaving very well here. And it's an ongoing fear that maybe the consumer is finally saying we've had enough, we're pulling back, and we're going to slow down our pace of consumption.
So we already established hog market down yesterday because of tariff fears, especially with Mexico. The bigger question is the funds are really long. Do they keep liquidating here, and how far do they take that market down?
Yeah, I mean, look, usually when funds are that long and they're that caught, like in the corn market, they're gonna sell at least, in my experience, in our experience, they're gonna sell at least half the spec position off to get their risk down to something that's more manageable. I mean, that's a general rule of thumb. They could liquidate more or less, but I would say until they liquidate half of what they had in the corn market and in the hog market, we would expect to see more pressure on the market. And then it comes down to, when do the commercials come in? When do the physical buyers come in to absorb that selling and tell you that the bottom is in? We clearly have not seen either market give us that indication yet.
All right, thanks so much. That's Sean Hackett with Hackett Financial Advisors with Markets Now.